video, we'll be going over IRS Form 982, Reduction of Tax Attributes Due to Discharge of Indebtedness in Section 1082 Basis Adjustment. So, in other words, this is the tax form that you might use to exclude from income certain types of debt discharge. So we'll go over ways that you can use Form 982, and then we'll go through each part of this one-page tax form in a little bit more detail. There are three parts to this. Part one, general information, where you outline the type of property indebtedness that you plan to discharge. In part two, in part one, you're also going to calculate the total amount of discharged debt. In part two, you're going to allocate that discharged debt either as a reduction in basis of certain property or as a reduction or elimination of certain tax credits based on Treasury Department ordering rules. So we'll get to that in a little bit. And then finally, in part three, corporate taxpayers that elect to use this form must consent to a general rule regarding adjustment of basis to commercially owned property under Internal Revenue Code Section 1082A2. So let's get back to the top. We're going to kind of talk a little bit about some of the terms that you'll see here. So Title 11 is basically talking about Chapter 11 bankruptcy proceedings as opposed to Chapter 7 or Chapter 13 bankruptcy. Insolvency rules have a certain play here. So when we talk about an insolvent taxpayer, that would be someone whose total liabilities exceed their total assets at the time of debt discharge. We'll get into farm indebtedness, real property, business indebtedness, and finally, qualified principal residence indebtedness. The majority of individual income taxpayers will probably be using this form either to discharge debt under a Chapter 11 bankruptcy in the case of insolvency, or qualified principal residence indebtedness. So, before we begin going through the form itself, let's take a moment to, well, as we go through this form, we'll take a moment to define each one. So, in part one, line one, you have 5 different boxes that you may choose. If you choose line 1A, this is indebtedness related directly to a Title 11 or Chapter 11 bankruptcy case. So if you check this box, you are most likely going to not check one of the other boxes. In line 1B, for example, if you consider yourself to be insolvent but not in a Chapter 11 case, then you would check 1B but not check 1A. So the insolvency exclusion does not apply to discharges that happen in a Chapter 11 bankruptcy. It also doesn't apply to qualified principal residence indebtedness, which we'll get to in box 1E. So you'll check the box on line 1B if the discharge of indebtedness occurred while you were insolvent. And you are insolvent to the extent that your liabilities exceed the fair market value of your assets immediately before the discharge. So, for example, if you owe $10,000 on credit cards, but you only have $7,000 of assets in your name, then you would be considered insolvent for the purposes of filing this form, and you would be insolvent to the extent of $3,000, which is the difference between your assets and your liabilities. If your indebtedness is related to a qualified farm, you would check box 1C. Qualified farm indebtedness, as defined by the IRS, is the amount of indebtedness incurred directly in connection with the trade or business of farming. To further define this, 50% or more of your aggregate gross receipts for the 3 tax years prior to the current tax year or the year that your discharge occurred must have been from the business of farming. The discharge has to be made by a qualified person who is an individual or an organization regularly and actively engaged in the business of lending money. This qualified person cannot be a relative, cannot be a person from whom you acquired the property, and it cannot be a person who receives compensation with respect to your investment in the property. A qualified person may be a federal, state, or local government or agency. In line 1D, this is qualified real property business indebtedness. So this is indebtedness that is besides qualified farm indebtedness that is incurred or assumed in connection with real property that is used in a trade or business. It would be secured by that real property, and you've made an election under this provision. So this provision does not apply to corporations unless it is an S corporation. And indebtedness either incurred or assumed after 1992 isn't considered to be qualified real property unless it is debt that was incurred to refinance real property incurred or assumed before 1993, or qualified acquisition indebtedness. And finally, the last definition has to do with qualified acquisition indebtedness. This is debt that is incurred or assumed to acquire, construct, or substantially improve real property that is secured by the debt, and the debt resulting from the refinancing does not exceed the amount being refinanced. So in other words, this is any business property that has real estate of some sort attached to it, where the entire property is, the debt is secured by the real property. And if you've refinanced or restructured the new debt does not exceed the debt that previously existed when you purchased the property and refinanced it. So a lot of ways that you can qualify business indebtedness under the real property provision. And finally, discharge of qualified principal residence indebtedness. So if the debt is discharged after 2017, there are certain rules that apply. Namely, one, the debt must be discharged before 2026, or discharge subject to an arrangement that was documented in writing before 2026. You cannot use this provision if you're in the middle of Chapter 11 bankruptcy. You must check the box on line 1A and follow those instructions. You may choose to use the insolvency rules by checking box 1B instead of checking box 1E. You should talk to your accountant if that's a consideration for you. So if you do check box 1E, you will need to complete line 2 and eventually line 10B if you continue to own the property after you've discharged the debt. So for this example, we're going to walk through as if we're discharging indebtedness related to our qualified principal residence. So to define, your principal residence is your main home. A qualified main home indebtedness is any debt or mortgage that you took out to buy, build, or substantially improve your main home. It has to be secured by your main home. It can't be a home equity line of credit from another property that you use to buy your main home. And only the debt that is equal to or less than the amount of your main home plus major improvements is considered to be qualified principal residence indebtedness. If you remember, before the Tax Cuts and Jobs Act, people used to take out mortgages and home equity lines of credit for much more than their home's value, and then they would be able to legitimately take a mortgage interest deduction for mortgages that ended up paying off credit card debt or car loans. And since the tax law has been redefined, qualified principal residence indebtedness is only a line of credit, home equity line, or a mortgage, even a cash out refinance, only related to the purchase of the home and any improvements. So if you refinanced a home and you took out an extra $10,000 to install a new air conditioning unit, that would be acceptable. That would be all included in qualified indebtedness. If you use $10,000 to pay off student loans, then you would have to back out $10,000 as qualified indebtedness. So in line 2, you're going to enter the amount of total amount of discharge indebtedness that you would like to exclude from your gross income. So we'll just say that this is $200,000 that we've gotten the bank to write off. We've got it documented in our form 1099-C, which is the cancellation of debt tax form you would expect to see at the end of the tax year. Under line 3, if you decided to treat all real property as if it was real property held for sale to customers, then you can make that election here. We won't do that, mainly because we're not discharging any debt related to real property, and we're not depreciating the property that we have. We're discharging debt related to a qualified principal residence as opposed to real property used in the course of trade or business or held for sale. So real estate agents may consider using line 3, or companies that own multiple parcels of real estate, but most individual taxpayers would not. So in part 2, we're going to actually allocate the amounts that we will exclude from gross income. So if we excluded $200,000 of gross income, then the total of these lines should equal $200,000. We're simply finding a proper home for each of those. So in line 4, if you discharged qualified real property business debt, you can use that write-off to reduce the basis of depreciable real property. So for example, if you had $2,000 of indebtedness that you would like to write off, and you have a commercial building that you bought for $500,000, that's your basis, it's worth $1 million. Instead of declaring $200,000 of income, you can simply reduce the basis of that commercial property by $200,000. So then the real basis of the adjusted basis of that property would then be $300,000. So in this case, we're not doing that because that doesn't apply to us. Under line 5, if you decide to apply either all or part of the debt discharge amount to reduce basis of depreciable property under Internal Revenue Code section 108B5, then you can do this under one of the other provisions, either A, B, or C. So Chapter 11, or insolvency, or qualified farm debt. This would not apply to your real property business indebtedness because you're already addressing that in line 4. So basically, lines 4 and 5 cover items A through D above. So the principal residence line is here. I'll go ahead and put this here, but then we're going to go back and walk through the rest of the form. So you can only enter this item in 10B if you've checked the box in line 1E saying that this was a discharge of qualified principal residence indebtedness. So you're writing off your primary mortgage or $200,000 of it, that's where that $200,000 would go. However, if your $200,000 was, say, related to one of these other items, real property, business indebtedness, and you decided that you were not going to reduce the basis of your property, now you've got $200,000 that you need to allocate into one of these other areas. You don't really get much of an option for items 6 through 13. They're based on ordering rules that are contained in Treasury Regulations 1.1017-1. This is the ordering rules. So let's imagine that we're going through this route and we're now trying to find ways to allocate this $200,000 of debt. So I've switched gears here because the primary residence discharge is pretty straightforward. Let's back out that $200,000. We're going to, we can put in, say, $50,000 as a reduction in basis. So this is an election. You can apply part or all of this $200,000. So if we put $200,000 here, then that would be pretty much straightforward, and we're pretty close to done with this form. However, if we're electing to do just part of it, $50,000, we now have to find a place to allocate the rest of the $150,000. So line 6 is used to reduce any net operating loss that occurred in the tax year of discharge or that was carried forward from the prior years. So let's imagine that we carried over a $10,000 operating loss. We also had general business credits as filed on IRS Form 3800, which is used to calculate general business credits. So let's imagine that we had $20,000 that is actually on our Form 3800 from last year. We brought that over. We're going to eliminate that business credit. That credit basically absorbs some of this discharged debt so that we can exclude it from income. So, you know, it would have been an includable item in income, but now we're wiping out a tax credit. So that's why we kind of use that to eliminate. Let's see, any minimum tax credit at the beginning of the year, immediately after the year of the discharge. So if there were any minimum tax credits that were, you know, carried over, then you would apply them here. For the sake of this argument, we'll just say none applies. Any net capital loss for the tax year of discharge. So we talked about operating losses, but if you discharge, you know, property in a prior year and you incurred a net capital loss that you're carrying forward, then you can eliminate down here. Let's just say $10,000. In line 10A, you'll use this to reduce the basis of any non-depreciable property if you did not reduce it on line 5 already. But you won't use this for qualified farm indebtedness. That's in line 11. So we'll say no here because we already reduced the basis up in, oh, sorry. We'll say no here, even though we did not reduce any basis on line 5. we're going to just keep going down this form. So far we've got $90,000 of indebtedness discharge that we need to, or that we've already allocated. We need to find a home for the other $110,000. Since line 10B applies to primary residences, principal residences, we're not going to check this. We already used that in a previous example. So for lines 11A, 11B, and 11C, this all applies to the discharge of qualified farm debt. So first, depreciable property that was not reduced in line 5. Then land, which is never depreciable, that was used or held for use in a trade or business of farming. And then finally, other property used or held for use. So we're going to put zeros on all of these. Line 12 is applied to reduce any passive activity loss or credit carryovers from the tax year of discharge. We'll say that we've been racking up quite a few passive activity losses over the years, and we finally now get to reduce those credit carryovers, because normally you can only use a passive activity loss to counter a passive activity gain. And then finally, the last section is applied to reduce any foreign tax credit carryovers either to or from the year of discharge. And we'll just assume that we have $10,000 of foreign tax credit. So if we look back, we'll see that we've got $50,000, $100,000, $150,000 here. We need to go back and figure out where we can allocate the other $50,000. And I'm going to push the easy button here and just reduce our basis under line 4 for qualified real property business debt. We're simply going to reduce the basis of the depreciable real property that we own. So we're reducing our office building basis by $100,000 because we couldn't figure out, we wiped out all of our tax credits and our capital loss carryovers. So under section 1081B, this basically, there's a section that prescribes a general rule for ordering property or debt discharge. So adjusting the basis of property in accordance with regulations prescribed under Internal Revenue Code section 1082. If you want to do anything else, then you must request this in writing before filing this form, and it has to be approved by the IRS. So the general rule of ordering, you're going to attach a description of the transactions that resulted in the non-recognition of gain. So we're going to simply state $200,000. Our tax year began in, we'll say, 1/1/2022. It ended 2022 on December 31st, and we were incorporated in the state of Florida, right? So that would be the example. So you're going to want to attach, description of the transactions that led to the non-recognition of gain if you end up doing this. So specifically, if no agreement is entered into, then the IRS will apply the general rule in determining the basis of your corporation's property. If you're an individual, like a personal tax return, you won't be completing part 3. This was for a business tax return. Let's just call it Acme Real Estate Enterprises, and then my employer identification number would be, right? So that's my, this is my form, and then this would be applied, this would be attached to, in this case, Acme Real Estate Enterprises tax return. If this was me and I was a sole proprietor, then this would simply be, and then my identifying number would be my social security number, right? So that's how you fill out this form. If you want to learn more about completing this form, we've written a step-by-step tutorial guide article that you can find on our website. Simply go to teachmepersonalfinance.com, type in IRS Form 982 in the search bar, and you should see the results come up. If you like our articles, please subscribe to our newsletter. If you like our YouTube videos, please subscribe to our YouTube channel. And as always, if you have any questions or comments or concerns, please let me know either in the comments section or by sending me an email. Thank you very much.